Well, hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. It's a brand new week and the focus this week will of course shift to the US Federal Reserve as we are waiting for the interest rate decision that comes out on Wednesday night. Lots of cues to watch out for today as well. Whether or not the weakness will continue into this week or not, we'll have to wait and watch and see how the markets open. The GIFT Nifty hinting at a very mild start for the Indian market, mildly positive, but let's see how really trade opens up at 9:15 a.m. But of course, we'll be getting all your stock-related queries answered by a technical expert on the show over the next 30-35 minutes or so. So if you have any queries, keep them coming in on our live feed on YouTube. We'll try and take them up. Of course, we'll also be joined by a big market voice on where the market is headed after the kind of correction that we have seen in the Indian market, in the first 2 weeks of March. But before all that, let's take a look at the top stories at this hour. Wall Street ends lower on Friday with the S&P 500 clocking a second straight week of declines. Sentiment sours as a hotter than expected Feb inflation report raises expectations of the Fed keeping rates higher for longer. The two-day FOMC meet kicks off tomorrow. Asian markets are mixed ahead of the release of Chinese retail sales data. I think it may have come out by now. And, the Nikkei, in fact, was trading with strong gains this morning ahead of Bank of Japan's policy rate decision that is due later tomorrow. GIFT Nifty, as I mentioned, hinting at a mild start for the Indian market. Crude prices surged last week, rising over 3% with Brent crude hitting $85 a barrel. Gold, meanwhile, posts losses for the week. In fact, I think it's the first weekly loss for gold in the last 4. While Bitcoin slips from record highs, was trading somewhere around $67,500. And the Election Commission announces dates for the Lok Sabha elections. Polls will be held in 7 phases starting from the 19th of April with nearly 970 million people eligible to cast their vote. 4 state elections will also be held simultaneously. Well, before we bring on board our technical expert for today, let me just take you through some cues for trade. The Nifty spot shut shop above that 22,000 mark. In fact, just managed to hold on to that crucial level by the skin of its teeth. We ended lower by just about 0.6% on Friday. But remember, for the week, both the Nifty and Sensex shed somewhere around 2%. It was the worst week for the Indian markets since October 2023. But if you look at the broader end of the markets, there was, of course, not a meltdown, but yeah, there was a fair bit of correction in both the mid and small cap indices last week. On Friday, the mid cap index ended lower by about 0.5%, with the Nifty small cap index actually managing to end the day in the green. But for the week, both the Nifty mid and small cap indices have shed somewhere around 5%, which makes it the worst week for the broader markets since December 2022. Aside of that, if you look at the India VIX index, it closed up by 0.5% or thereabouts below that 14 level at 13.69. That's where the India VIX ended. But if you look at the FNOQs, the Nifty open interest was down 2.7%, shed somewhere around 3.5 lakh shares. The Nifty March futures was at a premium of 109.8 point premium versus 117.9 point premium. Aside of that, if you look at the PCR, the put call ratio, that was at just under that 1 mark, so 0.99 versus 1.12. In the FNO band, if you look at stocks that will remain in the FNO band, you have Aditya Birla Fashion, BHEL, Manappuram, Nalco, Piramal Enterprises, RBL Bank, which was a new entrant on Friday, continues to be in ban. SAIL, Tata Chemical and Z, new in ban, Biocon as well as Hindustan Copper. And let's also take you through the fund flow picture. FIIs, in fact, were net buyers to the tune of nearly 850 crore rupees in the cash market on Friday, and DIIs on the flip side were net sellers, and they sold somewhere around 700 crore worth of shares in the cash market. But let me also point out that FIIs have been buyers in the month of March. They've pumped in as much as 40,000 crore rupees in the month of March so far. Of course, we saw quite a few block deals, which is why I think the FII figure looks how it looks really. But let's also get on board, our technical guest for today. Joining me is Milan, Vaishnav, who's the founder at ChartWizard and Gemstone Equity Research. Great to have you on the show, Milan, as always. 22,000 level, we've been holding on to that level by the skin of its teeth, right? But on the downside, what is the support level that you'll be watching out for? I think 21,900 is being much talked about, because if it breaks below that, I think there could be deeper sell-off going forward. What are your own thoughts?
Yeah, Nandita, very good morning to all of you. See, there are two things that I'm looking at the market. Number one, we take a look at the markets with a very short-term perspective, and then we zoom out a bit and take a little, a big picture in the view. So to speak, with the immediate short-term perspective, yes, we are looking at 21,900 levels, because that is the level which is the 50 DMA for the markets. If we see the markets violating 50 DMA, we can then fairly say that they might enter into a secondary corrective, secondary trend or a corrective phase. So that being said, yes, the immediate support for Nifty stands at 21,900 on a closing basis. If that stands violated, we might see some bit of incremental weakness coming in. But if we zoom out a bit and take a look at the weekly charts, then the Nifty stays in a little bit of a troublesome point, because it broke out from a rising channel when it crossed about 20,800 levels. And now what I see from the weekly charts is that the levels of 22,525, that's the most recent high, has almost become an incremental top for the market. And unless it's taken out, we won't see any increment, any kind of a steep up move in the market. On the flip side, the nearest pattern support rests at 20-week moving average, which stands way below at 21,200. So keeping a key eye on 21,900 would be important. Any weakness below that will be a bit of a sleepy situation for the markets.
All right, that's the key level to watch out for, 21,900. But for the Nifty Bank Index, 6th straight day of weakness coming in. Nifty Bank had just about started participating, and last to last week it was on a good upward trajectory. But of course, that has been snapped, as we've seen the Nifty Bank Index, clocking in a 6th straight session of losses, right? So on the Nifty Bank, what is the level that you'll be watching out for on the downside?
Nifty Bank may look relatively weaker than the Nifty, but it has just tested its 50 DMA, that is 0.1. And if we take a look on the weekly charts, and if we see it plotted on the relative rotation graph, which looks at the relative strength of all the sectors vis-a-vis the broader markets, I see that Nifty Bank may start improving its relative strength against the Nifty as well as the broader market. So it might be weak as of now, but I'm looking at the levels of 46,000 to 46,200 acting as major pattern supports for Nifty Bank. And from now on, I also expect Nifty Bank to improve its relative strength against the broader markets as well.
All right, that's the view on the Nifty Bank Index. But I want to get in your thoughts on a few stocks that will be in focus today. Starting with, Tata Motors. Of course, the government has announced a new EV policy, right, that could facilitate the entry of global players. So, that could mean increased competition for the likes of, the homegrown players like Tata Motors, M&M, Maruti. But particularly for Tata Motors, how would you view that, that particular stock on the charts for the long term? In fact, we also have a couple of queries coming in on this stock from Bhatt Yavar. He wants to know your thoughts. So very quickly, how are you viewing Tata Motors on the charts vis-a-vis Maruti now?
It's pretty clear that the last phase of up move in Tata Motors from 948 levels to the recent high of 1047, it has come with a negative divergence of the RSI. So it means that it was anyway lacking the internal strength. So if you look at the technical structure of Tata Motors, I believe it's time that we move away from Tata Motors, book some profit and take money off the table from Tata Motors and rotate the money in other good quality stocks, which are within the auto index, like we have Ashok Leyland, we have Maruti as well. So I think one should book some profits in Tata Motors and exit, and we can always re-enter if the stocks goes above 1040.
All right. Hope that answers your query. That should be the strategy for a Tata Motors. But I think just about a few seconds to go for market open. Let's see how the Nifty really opens up this morning. Given the fact that the GIFT Nifty was hinting at a fairly muted start. Coforge on charts. Let's first look at that ahead of the market open. Coforge has been in news given the fact that board has approved a QIP fundraise of 3,200 crore rupees. Stock has been fairly negative. It has been stuck in a downtrend. How are you viewing Coforge now on the charts?
Yes, with a stop loss of 6,000 on the stock, we can re-enter Coforge as of now.
All right, that's a view on Coforge. But markets have really opened up, and we have opened below that 22,000 mark, 0.2% kind of a cut coming in. And if you look at the advanced decline ratio on the NSE, in fact, it's 1,070 shares advancing to 520 declining. So breadth looks pretty okay at this juncture. Nifty Bank also starting on a negative note, 0.3% lower. If you look at the mid cap index, mildly lower there as well. I want to also see what the small cap index is doing. Remember on Friday it managed to end the day on a positive note. Even today, mildly positive, holding on to that 42,000 mark, the BSE small cap index. Sectorally, let's take a look at how auto is doing, because auto was among the top laggards on Friday. We'll waiting for the auto pack to come up. Yeah, weakness continues, 0.3% downtick coming in there. Banks, as I mentioned, has started on a muted note as well. Let's take a look at the oil and gas pack. Given the fact that we saw deep losses on shares of HP, BP and IOC, we saw the BSE or Nifty oil and gas index among the top laggards on Friday. Today, some bit of buying coming in for HPCL. That is one stock that was gaining, but BPCL continues to be in downtrend. And also pull up the BSE oil and gas index and see how that particular index is doing. Well, I think it's mixed trade when it comes to the oil and gas stocks. But let's take a look at some of the gainers and losers in today's session. M&M, that was among the top, Nifty losers on Friday. Today, it is the top Nifty gainer, 2% kind of a gain coming in there. Tata Steel, NTPC, Axis Bank, that's also among the gainers. And so is Apollo Hospitals, Divi's Lab, JSWC. So some of the metal and pharma names and even some of the technology names are among the top gainers. Reliance Industries, that's also started on a positive note. Let's take a look at some of the losers then. Adani Group stocks continue the slide. Even in Friday's session, we saw some of these stocks take a big hit. Today, Adani Ports 4% downtick there, and if you look at the other Adani Group stocks, they are also wilting in the red. Of course, there are reports that the Adani Group is ready with investments to the tune of somewhere around $14 billion over the next financial year across its businesses. But notwithstanding that, the stocks are under pressure this morning. Power Grid, Eicher Motors, Grasim, Hero Moto are some of the other losers in today's session. But of course, Milan is waiting by. Milan, what are the stocks that you're keeping on your radar this morning in terms of stock recommendations for viewers?
In terms of any stock specific recommendations, I'm looking at LTIM. One can enter LTIM above 5,200. Keep a target of 5,500 in view and maintain a stop loss of 5,000. Then the other stock I'm looking at is from the FMCG pack. I'm looking at entering ITC above 420 with the target of 435 in the view and maintaining a stop loss of 408.
All right, those are the recommendations. But among the stocks in news today, we also have a positive report on ICICI Bank coming in from Nomura. It has a buy rating, target price at 12.25 a piece. Of course, liquidity situation is gradually expected to improve as the advance tax payment overhang is out of the way. And margin picture, Nomura believes that FY24 margins are likely to be very similar to what we saw in FY23. and there could be a 10 basis point margin compression on a quarter-on-quarter basis in Q4. That was, of course, similar to Q3 as well. But, on the charts, how would you view an ICICI Bank as well as an HDFC Bank now? Because HDFC Bank, of course, has been an underperformer, right? And ICICI Bank has been among the ones that have outperformed in the banking index.
Yes, ICICI Bank has outperformed. In fact, it achieved a breakout when it moved above 1045 levels. But what I see right now on ICICI Bank is that it has shown a retracement from 1112, and right now it continues to remain under some kind of retracement, and it may continue to consolidate at these levels within a defined range. And it will take some time, or in fact, it will need to move above 1100 levels to resume its momentum on the upside. SDFC Bank, on the other hand, it might have relatively underperformed the banking space, but I think it has more promising days ahead than ICICI, because it has made a strong attempt to form a base for itself. The last phase of the downside has come with a bullish divergence of the RSI against the price. So we can fairly say that SDFC Bank can rise and go on to test 1525 levels over the coming weeks. ICICI, I expect it to continue to stay in a defined range, and upside momentum can resume only above ICICI Bank going above 1100 levels.
All right, that's the view on the private banking space. Hold that thought, Milan. We'll come back and discuss stock queries with you as well. But let me also bring on board the big market voice that I had promised at the start of the show. Joining me is Ajay Srivastav, who's the MD of Dimensions Corporate Finance Services. Great to have you on the show, Ajay. We are speaking after a long time.
Yes, good morning.
So over the last 1 month, we've seen some bit of gloom, come into the Indian markets, right? We did hit record highs, but, the euphoria, so to say, has been missing. And if you look at what's happening in the broad end of the markets, there has been a certain amount of gloom in the markets. A lot of people call it the March effect. Once this hangover is out of the way, do you expect April to bring about the much spring in the steps when it comes to the Indian markets?
I'm surprised you say the gloom effect, because I think all the investors, by and large, are sitting on huge profits at this point of time. Of course, the definition of paper money has come to boot in many cases, that you saw what was on paper profit disappeared, but you can't complain about it. Given the fact the way the economy in the world is, I think you made very good returns on a portfolio. Whether you encashed or not is your call. The market gave you every chance, so no reason to be gloom at all. And still, we don't have a situation of a catastrophe. You may have a little bit of problem in one segment of the market. Others are doing fine. So I don't think we should have gloom and doom. I think the key lesson takeaway is you need to book your profits at the end of the day. And and every rally has a plateau. You just can't have a stratospheric rise, and you will see consolidation in indexes. All that will come as part of the game. And I think, the good part about what's happened here is that there is no capitulation in the retail market. There's no capitulation of mutual fund redemption. There may be pockets of it like small cap, but by and large, it's been a good cap. And number three, most important, for the first time, I think this elections, I don't think we're looking at uncertainty. Now, you need to plan yourself out. That election results are kind of given. The victory margin could be plus or minus. The question is, assuming this government continues, what are you going to do with the portfolio? And I think those are the choices you see. And the Ides of March did affect Caesar, but I don't think so. Investors have been backstabbed in that manner.
Right, I'll just take a leaf out of what you just said, assuming that the government, of course, is coming back to power. There's stability on the political front. So how should you really be planning your portfolio as you enter the election months?
I think one thing is very clear, that the government spending is going to be lower than what it was last year, or at least the growth will be lower, because they will stick to the fiscal glide path which is there. So I think that changes the complexion of where you invest your money. Number two is, as you've seen yourself, what happened to the OMC, the price reduction when the oil prices are going up. The PSUs stocks, the re-rating rally will stop for some time till they see definitive action, either divestment or a change in the way the PSUs are conceived by them. So I think two things have happened. PSU investment, you need to put a hold on it. OMC's uncertainty has not come into board. Now, the third question is, what do you do with the capex stock? Because those have been the darlings of this one. I think capex stock is still a fair game at this point of time, because whatever the government does, it needs to bolster some capex either directly or indirectly. Railway stocks. Now, that's the conundrum which everybody is trying to resolve is, will that rally continue? And my guess is that again the rally will stop. Hotel stocks, I think, will fly, and airline stocks will fly along with them. So I think by and large the themes remain. Banks will remain under pressure because cost of fund is going up to them, and that's a raw material. It's like, any company saying steel prices went up and iron ore prices go up, and the steel prices cannot go up, and therefore the banks have a serious problem of raw material becoming more expensive. So by and large, I think you don't need to shift your portfolio too much, but the exuberance of PSUs, I think you need to get tempered a fair bit, and the reliance on government spending is going to go away. Defense stocks will remain the darling because India doesn't have so much money to buy from abroad. So more and more Indian companies will order. So nothing changes. The more it changes, the life remains the same.
Right. I want to also get in your thoughts on the small cap space, so to say. Of course, SEBI has used the word bubble, but would you go as far as calling it a bubble, or would you say these are just excesses that are getting cleared? Because, over the last 4 years, small caps have grown at a CAGR of 47%, and if you look at the large caps, small caps have outperformed quite a bit. Do you think it was just a correction waiting to happen and, perhaps some bit of froth is getting cleared, or would you go ahead and call it a bubble like how regulators have called it?
If you just go preceding to the 5 years, it was a slaughter of the small caps. Lots of fund managers really bet their reputation on small caps go away. It's the nature of the beast. Every strong market will have a pockets of exuberance, and investor will pay a price of it. So I'm not sure whether it's a bubble or this thing, but the kind of return that investors have seen, you don't need to quibble about. Bubble is where you're unable to encash the money. It just goes stratospheric up and then travels down. That's not happened here. People have got enough chances to make their money and get out. Are you saying the market of small cap is overvalued? Oh, by most certainly overvalued. Not because fundamentally, also because corporate governance is pretty weak in most of the companies. The supply is weak, the broker managed stocks, etc., etc. But, when you invest in these stocks, you go with this kind of risk. That's why they give you a 40% return when they give you a chance to go down by 20% in 5 days. But you still net out 25% plus. Nobody invests 100% in small cap funds at the end of the day. If you have done it, I think it's a sin to do it. But I would say the very simple fact, whether we call it bubble, froth, or whatever, these are expensive stocks because the liquidity is much lower, easier to get in, very difficult to get out. And therefore, it's important to be in the portfolio for your alpha, but also important to encash it. So, if you sit today, there is no rationale to invest in small cap because most investors want to head out and then get in. And you don't want to be caught going into a party which is already over. So I would just simply say the party is over for the time being. The overhang will continue. The hangover will last a few months or maybe a year or so. There's no need to enter this party now. The bubble is over. Everything is over. Go and do something else with your life.
All right, the small cap party looks like it is over for the time being. But let's talk about other sectors, where there has been policy changes as well, right? Government has cut taxes with respect to import of certain number of, EVs. Of course, that will facilitate entry of global players like Tesla. Now, how much of a setback is it for, the local EV players like Tata Motors, Maruti? They have been trying to up the EV penetration in passenger vehicle segment, which they haven't been able to do so far. Do you think entry of global players like Tesla would speed up the EV adoption, and B, how much of a setback it would be for local players in terms of competition?
One, of course, is that I think it's good for the industry per se. So it's good for the component industry. I think the major beneficiary is going to be the component industry because even if Tesla comes in and wants to indigenize, they need to buy materials locally to make it worth the while at the end of the day. So I think for the component industry, by and large, I think it's a great move that newer players are going to enter the market. Demand is going to expand and they will rely on newer suppliers. So key suppliers to EVs, I think, will be a gainer in this whole policy. Now, who's the loser in this policy? I doubt there are many losers because at the end of the day, whether it's a Maruti or Mahindra, they don't operate in this premium segment, at least till now. And Tata Motors, I think they have a significant presence overseas in any case in JLR at the end of the day. So even they can come in and start doing the same thing as Tesla can do it. So I think fundamentally, I don't think it affects anybody. It majorly affects the component suppliers in a positive way. And number three is, I think one of the beneficiaries indirectly could possibly be Tata Motors because now they can also start importing their CKDs which they make abroad. and sell in India at a concessional duty. And therefore, I think if all said and done, I think it's okay at par with Maruti because they're in the economy segment. Mahindra's in the SUV segment. I don't think we get bothered too much about it. The only one I think would gain is Tata Motors. Definitely should gain with the new policy. And the best place is for the EV component manufacturers. I think they will gain a lot. So I don't think many negatives to it. I think broadly it's a positive policy. And if more Teslas come in, I think sooner or later we'll have more component suppliers supplying to Tesla and going onto the global platform. So all in all, I think it's a fairly good policy. It doesn't affect anybody severely.
Okay, EV policy is a fairly good policy, but there's another spectrum, another sector rather, where there's been a lot of regulatory overhang, right? It's the entire NBFC space. How would you really be playing the financialization theme right now, given the fact that NBFCs, there is a regulatory overhang. PSU banks, the smaller ones have run up quite a bit, and with respect to private banks, we already discussed that there are issues with regards to cost of funds and margins. So how does one go around playing the entire finance theme at the current juncture?
I think more than finance, I think you brought up a very important issue that we keep analyzing fundamental demand supply. We never really focus on regulatory actions. And I think that's been the greatest killer of this. One of our portfolio choices has suffered a huge setback thanks to the regulatory action. And to that mind, I think the NBFC malaise is far more deeper if one goes to. And but the way the regulatory action has come, it has hurt investors much more than the management of these companies. I think that's where it's hurt most. That you can penalize the company, but penalize the people who ran these companies, disgorge their bonuses so that there is nobody else wants to do it. Now, what may happen in this company? Look at, let's say, an IFL Finance. The guy who did the booking got the bonuses, got away. They got the stock options, they got away because they met their target. Who got hurt? It's a common investor at the end of the day got hurt. So I think in that sphere, one looks at the financial space with great reputation to say who is next coming onto the way. And NBFCs, by and large, for whatever reason, RBI has never been kind of positively disposed towards NBFCs. The regulatory scenario has moved against them. They love the banks. They want to protect the banks. Fintechs were eating the lunch, dinner, breakfast. They have kind of rained down the fintechs. NBFC lending is being stopped or at least guarded at this point in time. So even if you play the NBFC play, it has to be in the top 2-3 players who can get their money up from retail market, the source of money, not the banks. NBFCs dependent on banks would have serious trouble down the line because one regulatory action and the banks will stop the limits. But even look at the top 2 or 3 NBFCs, they get money from the retail market. They can survive, they can grow. So even if you want to play the NBFC space, I think the top 3-4 companies are the only place for the time being. Let it be cleared off, let people come back clear, let the inspection report be over, and we can come back to 6 months down the line. Shares are not going anywhere in NBFC at this point of time. So there's no hurry to invest in them. But top 3 companies of NBFCs, I think you could be safe and sound in them.
Right. That's the view on the entire NBFC pack. But, last question really, Ajay. Everybody seems to be talking about industrials, capex story. But what about consumption? If somebody has a high proportion of consumption stocks in their portfolio, how should they really go about it? ITC, for one, there has been a stake sale by BAT. There's a good appetite for that. Most experts say that, a major overhang is out of the way. And business-wise also, they have reduced their dependence on the cigarette business. They are doing well when it comes to the FMCG business, and they're looking to scale up their non-FMCG business as well, right? So, how should one really play a stock like ITC? I know you don't talk stock specific, but how are things looking for ITC in particular and the entire consumption basket now?
FMCG investors as a block have a very different psyche in India. That is why if you look at it, the churn on the stock is very little. And if you talk to most of your friends, you'll find somebody's grandfather invested in Nestle and somebody's great-grandfather invested in Livers, and they never sold the shares. So I think, and therefore, these shares have commanded huge premiums. Sometimes they make good money, sometimes they don't make good money. But by and large, they have been the safest block of investment after IT for Indian investors. So, Indian consumption story is down. There's no doubt about it that people are struggling to spend money at the lower end. The upper end, like we discussed, 5-star hotels, airlines, is flying like a rocket. So we must be cognizant that consumption is low and will become lower in this country because the way the disparity of income is happening. Having said that, the supply of stock of FMCG shares is very limited in the market. These give dividends, they do buybacks, but you really find no or none of the FMCG guys doing a QIP or doing share issues or rights issue. And that is why you need to have a set of these, not because consumption will increase in next year, but over the next 5-year period. FMCG block offered the safest, best compounding theme after IT in this country. Good stocks, all the debt-free stocks, strong corporate governance, strong branding in the market, everything positive. So whenever they see a little fill up in consumption, the share price moves up. But it moves up in steps. You can't expect a trajectory like this. But I would say to investor groups, if you're building a portfolio, starting your life, they're unexciting, but they will be the best part of your portfolio after IT from a 3 to 5 year perspective. So keep at it, keep having it, keep adding it. Don't worry about next year's consumption. It will not be very attractive, but your shares will certainly do well over a longer term.
Well, very interestingly put, Ajay. But with that, I'm afraid we are running out of time. Thanks a lot for taking out time to join us this morning. And it's always a pleasure getting in your insights on a whole host of sectors as well as the market.
And smile, it's not gloom and doom. It's people made a lot of money, believe me. Smile.
Yes, we are smiling, and I hope that April month brings about the spring in the steps as well that I mentioned at the start of the interview. Thanks a lot for joining in, Ajay. But with that, let's go back to Milan, who's been waiting by very patiently. Milan, let's quickly address some of the viewer queries that are trickling in this morning. JSW infrastructure is one. We have a query coming in from Chirag on this particular counter. Today, it's up and about, 2% up or thereabouts. In the last 1 month, the stock hasn't really gone anywhere, although it is not very far off from its 52-week highs. But, for a shorter term period, like a couple of weeks, how would you view this particular stock?
I see that JSW Infra is slightly under consolidation. It has bounced off from its 100 DMA. So I believe that upside momentum can be expected only above 240 levels. If anyone is holding this stock, they can stay invested while maintaining a stop loss of 227. If you are contemplating a fresh entry, I would suggest entering the stock only about 240 to 42 levels.
All right, that's the view, Chirag. I hope that answers your query. The next one is coming in from Satya CK, and he wants your thoughts on fertilizer stocks, particularly GSFC and GNFC as well, the Gujarat Narmada Valley Fertilizers. Stocks are down in today's session. If you look at the last 1 month or so, they have been deep in the red as well. So particularly for fertilizer stocks, these two, any thoughts?
I think none of these stocks, whether it is GSFC or GNFC, are showing any clues of any bottom formation. GSFC is ruling near its 200 DMA, GNFC is well below its 200 DMA, and there are no signs of any potential base being formed in these two stocks. So my view would be to stay away from these stocks. If you are holding it, then I think one should consider moving out and find some better stocks where you have improving and rising relative strength. I would not suggest staying in these two stocks as of now.
All right, these two stocks are an avoid for now, Satya. But if I were to ask you, would you recommend any other stocks to him from any other space? What would you advise him to buy now?
Yeah, see, as I just said, when the markets are under corrective phase or when they're consolidating, one should focus on not on just absolute returns, but on one should also focus on relative returns as well. So keeping that in mind, I would suggest stocks that are improving in their relative strength. I would suggest him looking at ITC. I would suggest him looking at Ashok Leyland, and I would also suggest looking at LTIM as well.
All right, a whole host of stocks that Milan has mentioned. Hope that helps you and you keep those on your radar. But couple of queries have trickled in as we discuss these queries. Yagnesh wants to know your thoughts on Reliance Industries. He holds it at a level of 2,800. He's making some profit here. But the stock has, kind of cooled off after hitting fresh highs, right? So here, what are the levels you'll be watching out for and what should he do?
I think one should stay put in Reliance. It has come up from its high point. It has also mildly slipped below its 200 its 50 DMA. So if you are a short-term investor, I think you should maintain a stop loss of 27.50 on the stock and continue, or in fact make an exit if it slips below 27.50. But by and large, if you are prepared to hold this stock for even a medium term, I would suggest you to stay invested in this stock.
All right, stay invested. That's the call, Yagnesh. Hope that answers your query. We have a query coming in from Mohit Anand Bhatia on a PNB. He wants to know what he should do with this holding. He is holding shares at a rate of 78 rupees a piece. He's still making profits. It's at 118 right now. You know, this stock, of course, in tandem with other PSU banks, I think over the last 1 month has shaved off 9%, but still on a YTD basis, it's up 20%. Do you advise booking some profit here, if not all?
Yes, I would advise him to book some profits and take money off the table. Not just PNB, but entire public sector units, PSEs, PSBs, everything. The last phase of the up move, as I have been off repeating, has come with a negative divergence of the RSI. So some sort of even at least a temporary top can be in place. So it will take a while before these sectors make a new high. So my opinion would be to take money off the table from PNB. He's sitting on a decent profit, and I would reiterate that the profits, unless they are booked, they just remain a notional figure. So I would very strongly recommend to take some money off the table and book some profits in PNB.
All right, take some profits here. That's the advice. Hope that answers your query. Couple of more queries coming in. Just two more queries which we'll be able to accommodate this morning. Balaji wants to know your thoughts on a Titan. Titan, of course, has been losing shine. Even on a YTD basis, the stock is down 2.5% or thereabouts. Do you think this weakness will continue? And if somebody is making a loss here, how should one navigate?
If anyone is making a loss, I don't know at what level they have entered, but I would still recommend to stay invested in Titan. It has a strong support near 3,550, and then followed by 3,500. So long as the stock remains above 3,500, my suggestion would be to stay invested in Titan.
All right, to stay invested in Titan. Another query, the last one for today. This one is coming in on an Ultratech cement from Nitin, and he wants to know your thoughts. He hasn't really mentioned if he has any holdings or not, but at the current levels, would you advise an entry? It's somewhere around 9,625 at the current juncture.
Ultratech cement, it is following a corrective retracement. It is flirting with its 100 DMA, which is placed at around 9,577 odd levels. There are no chance, or rather no technical evidence that suggests that the stock will take support at 100 DMA, and therefore it doesn't trigger any fresh entry point right now. So I think one should wait for some signal to make a fresh entry. Right now, he should stay away from Ultratech cement.
All right, that's the view then. This wraps up our query segment. But before I let you go, Milan, Adani group of shares are under pressure today. Adani Ports, Adani Enterprises, Adani Total Gas. I mean, all these Adani group of shares are under a fair bit of pressure. What are you spotting on the charts? Do you expect some bit of weakness, or do you think it's just like some bit of weakness panning out now, and perhaps there could be some bit of rebound as we go ahead in the week?
Nandita, to be very honest, I have never been a big fan of this group of stocks. And if we look at the charts right now, they are simply behaving in a very highly speculative manner. So I would suggest that retail investors who are investing their hard-earned money into the markets should, at this point of time, stay away from these stocks.
All right, that's the view then. But one last stock, Tata Power. Torrent Power. This is one of the top Nifty 500 gainers as we speak. 6% uptick, 1227. Any trade you're spotting here for the next couple of sessions?
Yes. In fact, this is a strong attempt for a fresh breakout. I think Torrent Power can be entered right now at current levels, and over the couple of weeks time we can fairly expect at the levels of 1310 on the stock approximately.
All right, that's the view on Tata. I'm sorry, Torrent Power. But with that, I think we've come to the end of this edition of Opening Wealth. Milan, thanks a lot for taking out time and joining in and addressing all of your queries and sharing your thoughts on so many stocks with us.
My pleasure, Nandita. Thank you.
Well, taking a look at the markets, we're fairly, muted. In fact, tepid trade this morning, 0.3% lower for the Nifty. And even the mid-cap index is down somewhere around 0.5% or thereabouts. Sectorally, auto is one pocket that's doing well at a time when all the other sectors are trading in the red. So we've started the week on the back foot, but let's see how things really pan out, given the fact that we have that all-important Fed meet outcome later this week. But with that completely timed out on this edition of Opening Bell, thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates.